Okay, back again with the stream.
Bitcoin, I'm going to go into the chart and I'm going to show you what I think is going to happen in the immediate short term. But if you are watching right now, leave a thumbs up. Let's reach right south. Look at. Let me go triangle, and you can see here that we didn't break out yet. But I showed you yesterday that if we break out of this triangle, then we could go up to this point here, and this green box is $41,000 to $42,000. That's what I think could happen if we break 38.5k. You can see here, big resistance right there. Let me know these bear flags, right? Bear flag, bear flag, bear flag. If this is just a bear flag, then we could continue to go down for Ethereum. So 300, but yeah, guys, having fun as well at the same time. That's cool. I'm just doing this giveaway now. Actually, here you can see. Make sure to go over to the market right now. I will tell you right now. I think we are in a Bitcoin bear market on the daily time. I mean, I'm not gonna buy CRO right here. I think we're still in a downtrend. But yeah, many people.
The work that I've done suggests this roller coaster crash, and it is typical on a roller coaster that you go to the highest peak just before the greatest fall. Hi, everyone. I'm joined once again by Adam Taggart. And Adam recently did a wonderful interview on his Wealthion channel with David Hunter about what David Hunter sees in the future. And it's quite interesting because I've talked about the roller coaster crash before, that we are on this roller coaster crash where you've got the threat of deflation, you've got an inflation, and the markets go along with the inflations and deflations. And David Hunter believes there's going to be a huge melt up followed by a huge crash. Adam, can you tell us about this interview? Because I found it quite fascinating.
Absolutely. So yeah, I think roller coaster crash is a great term for it. I wouldn't be surprised if David steals that from you. Yeah, so David is, he's one of the more fun folks that I interview on Wealthion, and definitely one of the most controversial because his calls both go against sort of conventional sentiment, and they tend to be very extreme. One thing I will say is he is coming off a string of fairly prescient calls. So as bold as his forecasts are, I wouldn't encourage anybody to dismiss them. So you're very right, Mike. David is calling for an epic melt up in the stock market from here, and then an epic crash all in this year, all in 2022. Trying to give you sort of the condensed version of why. A whole bunch of factors, but he largely believes that looking at the scope of history, every bull market, every secular bull market ends in sort of a parabolic blow off top. And he doesn't believe that we've seen that yet, and now sees the conditions in place for that to happen. And by a parabolic blow off top, as well as the stock market has performed, particularly over the past year and a half, he still sees it having maybe 35% upside from here. So S&P going from 4,500-ish to 6,000 in just the next 3 to 5 months. A lot of people just can't imagine that happening. A lot of reasons go into that, including he thinks the Fed's going to reverse its hawkish policies at some point over that period. But again, it comes down to the fact that he believes that every bull market has that blow off top, and this 39-year secular bull market that we're in has been the biggest one ever, and therefore should have the biggest blow off top ever. And then, of course, based on all the macro issues that you and I talk a lot about, Mike, he thinks the market then is going to have to, basically go through a corrective reckoning. And it's so overvalued right now, and there's so much fragility and instability in the system that he thinks that things will crash 70 to 80%. Now, most people, again, can't wrap their brains around magnitudes of meltups like that or meltdowns like that in such a compressed period of time. Who knows if it's actually going to happen? But David puts forth a lot of his reasoning for it. Folks should go listen to that. By the way, Mike, he's very favorable on how gold is going to perform during this period. But most importantly, there is historical precedent for this, for corrections of blow ups and blow downs of that magnitude. In just a couple minutes, we're going to get to some charts that you pulled from the 1929 crash, which basically walked people through that. But very quickly, I want to get to the tweet of the day, which is basically a headline from one of the most famous roller coaster crashes that we've had before, which of course was the big 1929 crash. And this headline basically is from when, I think it's from late October 1929, the market had just fallen 23%, and everybody who never thought the market could drop that far that fast came out and declared that it was over. But then what happened after that?
Well, I'm going to get to that in the charts. One of the things I do want to point people to is about a year ago, I did a video comparing the 1929 stock market crash to today and showing the eerie similarities that happened throughout the late 20s and then all the way into 32. To paraphrase Winston Churchill, the further you look back into history, the further into the future you can see. And so, you really have to look at history. They say, I believe it was Mark Twain that said that history never repeats, but it often rhymes. And I am fond of saying history always repeats, but with little twists. And those little twists are based on the underlying fundamentals of the situation. So if you look at the fundamentals of what was happening in the stock market, what was happening in the economy, what was happening with the government and Fed policy and so on back in the 20s and into the 30s, and you study different moments in history with what they're doing with the currency supply and so on, as compared to what is happening right now, those little twists are going to make up the differences. The reason that history rhymes but doesn't exactly repeat. It repeats with a twist. And so I think we'll just move on to these charts here. The first chart that I've got is the blow off top that you're talking about here. Now, we're talking about just a few months here. So from late May 27th, you've got June, July, August. So this is a little bit over 3 months of data. And you're talking about going from, this is quite an enormous rally from 191 or 193, I believe it was, up to 381. This is an amazing percentage gain. Now I'm going to back out a little and go to start this chart at 1928. So you can see that blow off top, if you look at the low in May of 29, that's what we're talking about. There was another big rally before that, and then a consolidation. But from late February of 28 to early September of 29, you're talking about a doubling. We went from 191 to 381. This is enormous. And the euphoria that they had back then was very similar to the euphoria of the stock markets today. Then, that's September 3rd is that chart. The next chart is the 18th of October. And you can see that there had been a pullback. This was not the crash yet, And it sort of developed a little head and shoulders pattern, which is interesting. And then over the next 9 calendar days, now these are calendar days, 9 calendar days could incorporate 2 weekends. So this is a maximum of 7 trading days, but possibly as little as 5 trading days. It crashed all the way from that 333 points down to 230. This this was so blindingly fast. It's an enormous crash in a very, very short period of time. And then the day after that is when the author, that was on the 29th, this headline of "Brokers Believe the Bottom is Reached" is on October 30th, the next day. And so the crash had stopped, there was a bounce, and that headline was written on October 30th. The next chart here is November 13th, but October 31st, the very next day, was where the Dow peaked and then rolled over again. So that prediction, that headline, was true for 24 hours, and that was it. And then we had a 5-month rally after this temporary bottom of 198 was reached. So you've gone from 380 to 198, and then a rally up to 294. So,
right, and Mike, just to chime in there, so that headline came out and said, "All right, folks, wow, we didn't see this correction coming, but the bottom's in." It bounced for a little bit, then dropped again, to a point where everybody said, "Okay, we were wrong the first time, but this is the bottom." Then they now have this pretty substantial rally, by the end of which people are feeling like, "All right, well, we're out of this thing, and we're recovering our losses, and looks like sailing is going to be good from here."
Right, but then anybody that did get in suffered some tremendous losses, and if your stocks pretty much averaged what the Dow Jones was, it took about 5 months to recover, and we did get back up in April of 1930 to a breath away from 300 here, 294. But then take a look at what happened over the next couple of years. So look at April of 1930, and you can see that peak of 294 in April of 1930. And the next portion of the crash that brought it all the way down to 41.22 points. And now I want to, in studying for my chapter on the Great Depression, this was many, many, many months of reading Milton, the 3 main books that I focused on to write that. And I do want, anybody that hasn't seen my video on the crash of 29 compared to today, really should go and watch that. And if you did watch it, but you only watched part of it, you should watch it to the end, because it sort of gives you a preview of what could happen. You just need to know what all the fundamentals are. But in that video, I show all of this, and I show what was going on politically, what was going on in the markets. That the books that I read to do that, the main books, I picked an Austrian economist, a Keynesian economist, and a monetarist. So you've got Milton Friedman, the monetarist, Ben Bernanke, the Keynesian, and Murray Rothbard, the Austrian. So America's Great Depression from Murray Rothbard, Essays on the Great Depression by Ben Bernanke, and the monetary history of the United States from 1863 to 1960 by Milton Friedman and Anna Jacobson Schwartz. All, well, with the exception of Ben Bernanke's book, all really good books. I've said many times, if you ever get a chance to read some Ben Bernanke, don't. It's just going to make your head hurt. And it really does. I mean, you got to try and decode everything that he says. But I want to read you a quote from the economist John Kenneth Galbraith. Now, John Kenneth Galbraith was also the economic advisor to, I believe, President Kennedy and Johnson. I'm not sure. Somebody's going to correct me on that, I'm sure. But anyway, in his book about the Great Depression, I ran across this paragraph and just had to take it as a quote. almost everyone believed the speculation could now be resumed in earnest. So we're talking about that temporary bottom that came right after the crash and that newspaper article that you were talking about. A common feature of all of these earlier troubles was that, having happened, they were over. The worst was reasonably recognized as such. The singular feature of the great crash of 1929 was that the worst continued to worsen. What looked one day like the end proved on the next day to have only been the beginning. Nothing could have been more ingeniously designed to maximize the suffering and also to ensure that as few as possible escaped the common misfortune. The man with the smart money, who was safely outside of the market when the first crash came, naturally went back in to pick up bargains. The bargains then suffered a ruinous fall. John Kenneth Galbraith, The Great Crash. And so that's in the video. But the final chart that I want to show you here, after the Dow bottomed at 41.22 points, all of these charts that I showed you started in 1928. Stock charts, where I generated these charts, only has data going back to the year 1900. And there is no low lower than this 1932 low. It wiped out more than 30 years of gains. And, so I can't go back into the 1890s or the 1880s to find the gains that this completely wiped out, but it wiped out all the gains of the 20th century to date at the time. So this was a 90% crash, basically. It's 89 point something, and if you round it to the nearest number, it's 90%, the nearest whole number. I think David Hunter might be conservative because we're in a far bigger bubble by any measure. PE ratios, price, that's price earnings, price sales ratios, the Buffett indicator. It doesn't matter what you pick to try and figure out, is the stock market in a bubble or not? It's in the biggest bubble in history, which far exceeds, usually by multiples, the peak in 1929. And the monetary system back then, even though it was so poorly designed, we had what was called the gold exchange standard. The classical gold standard ended with World War I, and we had this cobbled together, man-made, poorly designed monetary system that fell apart because of this crash, but it had created the imbalances and the bubbles. Well, the system that we've got today does not use something that's in fixed supply as its foundation, such as gold, as we had. They were cheating the gold standard with the gold exchange standard. The results, the energy that was stored up came back to haunt them as this giant bubble and crash. A lot is the Federal Reserve is responsible for here. And today we have a system that's based on strictly voodoo. There's nothing there except the promise to tax us in the future. But the Federal Reserve, with just a couple of keystrokes, can create $1 trillion at any moment. Nothing really backing it except the promise to tax us in the future. And through open market operations, they always go into the financial sector. For a while here, we're seeing big inflation right now because they created currency to send out checks to people during the pandemic here. And so that is the reason for the consumer inflation. But the market has been inflating for decades now, and the biggest inflation has come since 2008, where when this crash happens, it's the Bernanke bust is what's going to happen. Ben Bernanke caused all of this. Yellen and Powell just sort of carried on the tradition, but Ben Bernanke was the first one to start typing trillions of dollars into existence and pumping them into the financial sector. What is your take on all that?
Well, first, I just want to say, Mike, you did just a wonderful job walking through all that. So thank you. It was actually really fun to watch, even though I had seen the charts in preparation of this video. And real quick, folks, if you enjoy this type of work, please don't forget to like this channel and click the subscribe button below as well. Hearing you go through all that, Mike, a couple things came into my mind. One was building off of your comment about history rhyming. There's the old quote too, that those that do not study history are condemned to repeat it, right? And I think that that's the danger that we face at this stage, is so many people just don't think anything like this could happen again. And that's really where David Hunter, zeroes in his work. He is a contrarian investor. And his, major sort of investing lens is trying to find the things that people don't think could ever happen that actually have a good probability of happening. And for all the reasons you just mentioned here, there's more than enough fragility in the system to have, another type of corrective event like this. And it's amazing when you look at, this chart you put up from, 1900 to the mid 30s. That, folks, is an elevator to hell. That when the market just completely melts away like that. And Bill Fleckenstein, who I was interviewing the other day, he said asset price inflation is more dangerous than just goods and services price inflation, because it creates so much malinvestment that when it pops, that pop is so destructive, and you can just see, visually what that destructive potential is here. I mean, it's a vaporization of 90% of the wealth that's out there. And as your Galbraith quote said, not only did it destroy the people that were in the market, but it destroyed many of the people who were out of the market because they were playing by the old rules. Okay, when this market drops, it's the 1920s version of buy the dip, right? I just got to come in and pick up these now clear bargains because the market's corrected by 20%, by 40%, by 60%. And yet they continued to get wiped out as this vortex just drove everything lower. So look, I don't know if David Hunter is going to be proven right on the timeline that he's saying this is all going to happen, but I don't think you can discount that to zero. And you've got to, at least open your mind to the possibility that if we see something similar to what we saw back then, you got to be very, very careful about how to, what interaction at all you want to have with that correcting market. You really want to be prioritizing both risk management and capital preservation, and really finding ways to park your money in things that are not going to lose their purchasing power. Of course, we talk a lot about gold on this channel, but that's a huge reason why gold makes a lot of sense right now.
Yeah, one of the things I want to say about David Hunter's video, it was great, by the way, but the whether or not the melt up comes, and I do think he's right, because these things always end with some sort of blow off top, and we're just not seeing that right now. We're sort of seeing a continuation. Maybe it gets, but we could go down from here, but I doubt it. I think he's probably right. But when this crash happens, the Fed is now, they've painted themselves into a corner where there is no good way out. If they tighten, there's a crash. If they don't tighten, they put off tightening, right? And so now the markets can party. So maybe this blow off top is inevitable. But when the crash comes, how are they going to try and stop it? They're going to try and stop it by typing up trillions and trillions and trillions of dollars and trying to get the markets to rise again. They're going to try to stop the economy from falling apart. Well, that causes loss in faith of the currency. And so I believe that this time, you got to remember too, like if you look at the Dow gold ratio, the Dow was moving, gold was fixed. It was $20.67 an ounce. This time, they're both moving. So this time, I think the crash could actually be more vicious. I think it could be more of this 90% crash instead of the 70, 80% crash that David Hunter was talking about, because it could be accompanied with a currency crisis. And that causes gold to go to the moon. And in 1932, when the Dow was at 41.22 points, basically the Dow gold ratio was at 2 ounces of gold bought the Dow, $20.67 an ounce. times 2 was just slightly above the points on the Dow. And we saw it go to 1 in 1980. And I've been saying that we could see it go to 0.5. In other words, gold being twice whatever the Dow is. It doesn't matter what that figure is. This is your true gains, because this is gains in value, not price. The price doesn't matter. If they inflate the currency supply and gold goes to $1 million, but a cup of coffee is 2 million, that means gold fell while it was going to 2 million, to $1 million. So anyway, yeah, I think it was an amazing video. Congratulations on that. The work that I've done suggests this roller coaster crash, and it is typical on a roller coaster that you go to the highest peak just before the greatest fall.
Great, and I love that term, roller coaster crash. And just for completion, 2 things about Hunter's outlook with gold. One, he looks at gold and silver and the miners as doing particularly well during this melt up. So his current targets are by sort of, you know, the end of the melt up. He sees gold going to 2,500, silver going to 50, right? So that's more than a double for silver right now. And he sees the miners as more than doubling as well. He also, just as you said, Mike, he does expect the Fed and the other central banks to come out with just gargantuan amounts of stimulus, you know, in the depths of this crash, trying to reverse it. And so he sees the future after the crash has happened as being a persistently highly inflationary one, and thinks gold, silver, other commodities and hard assets will do well in that environment too. So
right,
just for completion set there. Anything else? Feel free to anything else you want, but I want to make sure we get to your quote of the day here, because you have an excellent quote that kind of goes well with what we've been talking about.
Okay, but what David Hunter is saying is that the end of the gold will do well during this melt up, but the end of the melt up is simply the launch pad. I mean, this isn't even like getting to the second stage yet. That's the launch pad for the rocket of precious metals. Okay, so quote of the day: when the whole world is running towards a cliff, he who is running in the opposite direction appears to have lost his mind. C.S. Lewis. And that is perfect for this video. I want to thank you so much, Adam, for joining me, and everybody should go and visit Wealthion and watch that David Hunter interview. Thank you very much. We'll see everybody next time. Thanks, Adam.
Thank you, Mike. Always a joy.
number, it's 90%.
Where everybody said, okay, we were wrong the first time, but this is the bottom. Then they now have this pretty substantial rally, by the end of which people are feeling like, all right, well, we're out of this thing, and we're recovering our losses, and looks like sailing is going to be good from here.
Right, but then anybody that did get in suffered some tremendous losses, and if your stocks pretty much averaged what the Dow Jones was, it took about 5 months to recover, and we did get back up in April of 1930 to a breath away from 300 here, 294. But then take a look at what happened over the next couple of years. So look at April of 1930, and you can see that peak of 294 in April of 1930. And the next portion of the crash that brought it all the way down to 41.22 points. And now I want to, in studying for my chapter on the Great Depression, this was many, many, many months of reading Milton, the three main books that I focused on to write that. And I do want, anybody that hasn't seen my
All right, y'all. So today we have to talk about Bitcoin. What I want to do is I just want to look at the charts, and just the charts, because you have people who have so much mixed sentiment in the market right now. You've got your people calling for 57K, 60K, massive breakout of 41,000 that will just keep going parabolic, calling the bottom being in right now. You've got people calling for a $20,000 Bitcoin, for a $14,000 Bitcoin, and even lower. And so what I want to do today is I just want to look at the charts, and then we can kind of gather all the information that we can to come to our own conclusions about where the price of Bitcoin is heading. So make sure to like the video, make sure to subscribe to the channel. This is a place where you will get golden tidbits of trading information, as well as regular technical analysis updates. So I want to start locally, and I want to zoom out. We can see that locally, Bitcoin has been trading sideways in this range since about the 21st of January, and we've been coming up in this rising wedge. Now, some people are calling this actually an ascending triangle. Okay, now the reason I don't necessarily like calling this a ascending triangle is because we do see that when we wake up, we tend to get higher and higher, and we are respecting this resistance as a diagonal resistance. And every time we come up here, we are able to reject from it. In fact, I've been able to take 3 shorts, one from here, and currently now, well, I actually took 2 from here, little scalp shorts. And these were juicy shorts, guys. By the way, in the VIP Discord, shout out to everybody who took these trades with me. We were looking to short right here, which we did. Looking to short from the next one, which we did. And currently I am still in a short. And the one thing I want to point out about this sideways range right now, guys, is the fact that we are getting what appears to be bearish signals on some of these medium-term time frames. Okay, the 4-hour time frame, the 3-hour time frame, the 1-hour time frame. We are getting momentum and money flow coming down as Bitcoin continues to put in higher highs and basically is consolidating in this little area. Now, is this bullish or is this bearish? I think it's neutral, and I think we need to identify some key levels on the chart from which we can determine what is likely to happen if Bitcoin hits those levels, because the truth is, right now, we are kind of in the middle of no man's land. But if we are just going to take this pattern objectively, this is a bearish pattern. A rising wedge is a bearish pattern that breaks to the downside. That is especially true if we see momentum making lower highs and money flow making lower highs as the price continues to make higher highs, consolidating into this apex of the wedge, which we will then break down. Now, even if we do break down out of this wedge, the target of this would simply be a trend line from the high, the low to the wedge, and we can see that even if we break down from here, we would only be coming down to put in a higher low. Okay, we would actually be coming down to put in a higher low, and this is one scenario that could very well happen, where we come down, put in a higher low, and then actually do continue to the upside. Now, one of the swing trades that we do have going on here in the VIP Discord is this one right here, this swing trade that we're in right now, where we did see that we came down to this very important area of support, and we actually did take a long from here. I am in multiple long positions from here, potentially having put in a higher low on a macro time frame. And to confirm that we are actually bottoming out, what I would like to see, if I turn off some of these things right now, is I would actually like to see us now come in and put a higher low down here. Okay, if I turn on some local areas of support and resistance right here, we can see that we do have some really nice areas of support. If we come down and we either hit this golden pocket area around 3,500, or we come down a little bit lower to hit some of these naked point of controls down around